Every year, thousands of Indian startups receive term sheet for raising funds. But not everyone are finally raising funds. Many see rejection even after getting a term sheet. Not because of their idea, not because of the founders, but they usually die at one single place, and that is called due diligence. Welcome to the Due Diligence Show with me, Gautam Palaniswamy, founder and CEO of Kama and also the creator of the Kama Circle. I've spent my past decade on the other side studying the data rooms of the startups, enabling startups from the incubators and part of some VC. Now, through this show, I'll take you to the most crucial part of the fundraising journey, that is the due diligence process. This show is intended for founders who are going to raise their funds or any student who wants to explore the innovation and startup ecosystem. You might not be a founder or student. If you are any individual who just explores things around the ecosystem, yes, we cover you also. In every episode, we will discuss about one document, one type of process, where it exactly comes from, and how you should be prepared of it. This is the first episode, and today we'll discuss about what is due diligence actually about and how the process will happen overall. Let's get into the show. Firstly, let's strip away the jargon. Due diligence. We simply call it as DD. So what this DD actually means is it's an investor's structured process of verifying what you have told is correct or not. That's it. So investors are structuring in a way to check whatever you have pitched in your story, that I have this many customers, I make this much revenue, I have this many more orders to come, I am present in this much areas, all the stories, whether it is true or not, whether the story you have pitched is matching the paperwork you have done. That's the process of due diligence is all about. So whenever you are hearing from an investor saying that, okay, we like your idea, we are initiating the DD, don't get fear. They like your story, now they want to verify it. If you wonder why this process people are doing, think of a scenario that you are going to buy a 3 BHK flat. You are searching across multiple brokerage sites and you have found a very good property around. But would you just believe that random listing which has a beautiful photos, which has a beautiful details on the location, the pricing, and the broker also says that, okay, this place is totally safe and we have all the documents ready? No, right? You'll definitely appoint a lawyer or try to do a cross verification from your side. Same with your startup. That's what due diligence is all about. Here, unlike a flat, your startup is a moving architecture. So this has customers coming in and not, whether like an occupancy certificate, whether your startup has a proper certifications or not. So if you care about your lifetime earnings putting into a still standalone 3 BHK flat with so many checkings, same thing with the investors. They are also going to put their money in a moving architecture, that is your venture, your startup. They hardly know you for weeks or months, but to trust your venture for so long time, this due diligence plays a key role. So nothing to fear about due diligence. Whatever you have pitched in your story, whether it's right or wrong, that cross verification is what the due diligence is all about. As I said, they like your story, but they are asking to show your receipts. Simple, right? Now you can ask, why do investors do this actually? I could say three main reasons. So the first thing is, every VC firms, they are not operating on their own money. Obviously, they handle the funds of the limited partners who have invested on them. Like you are investing your own money with utmost care, they are investing the third person's money, that is the limited partner's money, on your venture. So they should ensure the utmost care, ensure the moral duty of legally, financially verifying every process of your company. This is the first and the primary reason why investors start the due diligence process, and they do for your venture. Secondly, it gives an information asymmetry. That is, you are in your company for so long time, that is from day zero. But these investors come into the company or at least know about your company weeks and months before. So to bridge this gap, this day zero to this recent gap, so many things have happened in your company. So to understand this, to fix this understanding gap between you and the investors, this due diligence process is initiated and it's really helpful in this part. Third, and the most important thing is risk pricing. In every red flag that is being raised in a due diligence process, don't fear of losing your deal. Don't think that one red flag can close your deal. Actually, every red flag will help founder in correcting the mistake, but on the investor side, it will make sure that the deal is structured properly. For every risk, they are taking a mitigation process. For every risk, they ensure they are de-risking this so that they have a long and stable relationship with you. But of course, many red flags leads to the deal closure. On a negative way. So the honest way to look around it is, DD process is not to accuse you. It is just to make you so serious to take on someone's money so seriously. This works right. So next, the core part. Due diligence is not a single lens. Actually, investors wear 5 or 6 different lenses to view your company. And that forms 6 types of due diligences. Everything will take part in the journey, but these 6 are the pillars of the due diligence. The first, the financial DD. So this covers your P&L, balance sheet, cash flow, burn rate, revenue recognition, unit economics. So all the numbers you have mentioned in your pitch deck is true or not, whether you have proof for that or not. So that's what covered in this first pillar of financial due diligence. Secondly, legal due diligence. So this covers your incorporation documents, cap table, shareholder agreements, board resolutions, past fundraising paperwork, litigation history, and every material contracts you have. So this is where people will identify whether your cap table is clean or messy for all the stakeholders of your company, how strong you have your contracts with your vendors and customers. So this is what being done in this second pillar. Next is what the tax and regulatory DD. So GST filings, TDS compliance, ROC filings with the Ministry of Corporate Affairs, any past notices from tax authorities, everything comes in this process. And this is where most of the Indian startups get tripped about. We are almost in sometimes trapped off, because we always take this compliance part for granted. We always treat this government compliance like we'll fix it later. If you are thinking that in that zone, definitely in your DD, you'll get struck in this third pillar. Moving forward, fourth is going to be the technical and IP related DD. That is your intellectual properties, like who owns your code, your product. Is your core intellectual property actually assigned to the company, or is it still sitting with that freelancer or a co-founder who left company ages ago? For tech startups, if this is not proper, this could lead to breaking the deal. And fifthly, the core pillar for almost all companies is more on the commercial or usually a market DD. So are your customers real? Will they talk to the investor and confirm what you have claimed? Is the market size you quoted actually defensible or copy pasted from a random Google report? So these sort of questions will get answered in this part of DD. Finally, most surprising part for some, if you are not aware of, is what? HR and team related due diligence. Founder vesting schedules, key employment agreements, ESOP pool structure, and what sometimes called as like key man risk. Everything is get assessed with this part of DD. You might say you have the best team in the world, but is it true to its nature is what being assessed in this process. So these 6 are the core arms, core pillars are the core categories of the due diligence process. Every startup goes into this process, and this is what I said. In every category, one document we'll deeply dive into it, and every of our upcoming episode is going to revolve around this. I bet you this will be informative for you because 6 lenses, one single business, and it might get upgraded or downgraded based on your sector as well. Till now, we didn't go into any sector. I'm just speaking about the due diligence happening with every company. So we'll break into every process in the upcoming episodes. So this entire series is powered by the Kama Circle, the community which we have created from the House of Kama for all the founders, for all the students, for all the individuals who wants to explore a peer learning experience by investing just 1 rupee per day on your personal growth. So our membership is just 365 rupee a year. If you feel this works for that, our community joining link is given in the description. Do check out and we'll meet you in the next episode.